Nvidia stock has been on an absolute tear for the last several years, but recently the momentum has stalled. The stock is down nearly 12% this month, and pre-market pricing shows even more weakness. So what's going on? Why is Nvidia stock falling right now? And here's the big question: does this dip represent one of the best buying opportunities that we've seen in years? Let's break it all down. If you look at the chart I have on the screen, Nvidia ran up to around the $210 range, but then sold off steadily over the past few weeks, dropping to around $182 with pre-market dipping even further. Three major forces are causing this. One is AI hype has slowed down temporarily, at least. That's what we know. The explosive AI frenzy that pushed Nvidia into a $4 trillion market cap has cooled slightly. Investors are rotating into companies that haven't already 20, 30x over the last few years. Two is profit taken by large hedge funds. When hedge funds have massive gains, especially heading into year end, they like to lock in profits. Nvidia is one of the most profitable trades of the decade, so naturally it becomes one of the first places they trim. And three is concerns about slowing data center orders. The market is worried Nvidia's biggest customers, Amazon, Google, Meta, Microsoft, may reduce GPU orders in 2025 as new capacity comes online. Even small hints of demand moderation can cause swings in a stock priced for perfection. But here's where things get interesting. This decline has little to do with Nvidia's fundamentals. According to the data that I have on the screen, Nvidia's 3-year revenue growth is roughly 87%. The 5-year growth is over 66%, and even over the past decade, revenue has grown more than 40% per year on average. These are staggering numbers for a company with a multi-trillion-dollar market cap. Earnings are even more impressive. Nvidia's diluted earnings per share has grown about 157% over the last 3 years and more than 90% over the last 5 years. Most companies dream of 10 to 20% earnings growth. Nvidia is delivering triple-digit gains. Its gross margins are around 70%, which is extremely high. Operating margins are close to 59%, and the free cash flow margin is about 41%. These margins aren't just good, they're among the best in the entire stock market. Nvidia's balance sheet is also incredibly strong. The company has over $60 billion in cash, and after subtracting debt, its net position is actually negative $50 billion. In simple terms, Nvidia has more cash than debt, giving it tremendous financial flexibility. The debt-to-equity ratio is close to zero, which is almost unheard of for a company of this size. Then look at the profitability metrics, they're off the charts. Nvidia's return on invested capital is around 86%. Return on equity is about 75%, and anything above 15% is considered very strong. Nvidia is several times that level. Now let's do a bit of valuation talk. Nvidia currently trades at a price to earnings ratio around 45, but the forward price to earnings ratio is closer to 26. That means analysts expect earnings to grow fast enough that the valuation becomes much more reasonable over the next year. Analysts also have a price target in the mid 200s, which suggests meaningful upside from the current levels. So if the fundamentals are this strong, why is the stock really falling? Well, it comes down to expectations. Nvidia has been priced for perfection. Investors have assumed that AI demand will grow endlessly, that margins will stay extremely high, and that competitors will barely matter. So any headline about slowing data center spending or new competition or macro pressure can trigger a pullback. Competition has also become a bigger story. AMD is releasing the new MI300 series chips. Big tech companies are developing custom AI chips, and Intel is also trying to re-enter the high-performance GPU market. Nvidia still dominates more than 80% of the AI accelerator market, but headlines about competition can impact sentiment even if Nvidia's lead is still huge. Macro conditions, they also play a role. Higher interest rates tend to hurt high growth stocks because future cash flows get more discounted heavily. And finally, export restrictions have limited Nvidia's ability to sell some of its higher end chips into China. Nvidia has created new export compliant chips, but the market is still cautious about how much revenue China will contribute going forward. So the big question is this a buying opportunity? Now, there are strong arguments on both sides of the table here. On the bullish side, Nvidia's fundamentals remain exceptional. Nothing about the long-term AI story has changed. Companies, governments, and research labs are still in GPU acquisition mode. The world is only in the first innings of the AI build-out. Data centers, AI PCs, AI smartphones, robotics, autonomous driving. Every one of these trends requires Nvidia hardware or Nvidia software. The company is also preparing for its next major architecture, Blackwell, which could spark another upgrade cycle across the entire industry. And Nvidia's ecosystem, especially CUDA, creates a massive moat that competitors struggle to overcome. It's the Apple ecosystem of AI computing. On the more cautious side, Nvidia is still priced for high growth. A forward earnings multiple of 26 is not expensive for a company growing this fast, but it does assume that demand remains strong. If data center spending slows, even temporarily, the stock could remain volatile, competition may slowly erode Nvidia's market share over time, and macro pressure could continue to influence tech valuations. So, does this drop deserve to happen? In the short term, yeah, Nvidia has become overextended, sentiment was extremely bullish, and expectations were nearly perfect. A correction brings the valuation, some would say, back to earth in some sort of way. But long term, Nvidia's business remains one of the strongest in the world. The fundamentals point towards continued dominance, continued growth, and continued leadership in the most important technological shift of our lifetime. That's hard to debate. If you believe AI is still in its early stages, then this dip could easily be remembered as one of the better buying opportunities of the decade. Short-term volatility will likely continue, but the long-term story remains powerful. I'm a little bit wary of Nvidia myself. It's priced so high, and if you just have one stumble with earnings or delivering GPUs, the stock could crumble a lot more.